Hi everyone, Amanda here, your tax girl. In this video, I want to go over IRS codes and tax strategies in regards to rental property, particularly depreciation and the recapture of it. The IRS was nice enough to let you depreciate that asset over time. Now you're ready to sell and the IRS wants their money back. A lot of people are not aware of recapture. When you sell your property, that money needs to be paid back. In this video, I'm going to go over basis, depreciation, recapture, and strategies that you could do to avoid this. Before we dive in, please like and subscribe this video. I greatly appreciate it. And let's begin. So you purchase a property for $500,000. Now you cannot depreciate land, so you need to minus the land. Say the land is worth $75,000. Your basis for depreciation purpose is $425,000. You want to do some capital improvements. You want to change the roof. Maybe you want to update the floors. So say you spend $50,000 in improvements. Your new basis for depreciation is now $475,000. You depreciate rental property over 27.5 years. So you take your basis for depreciation and you divide that by 27.5. And that's going to give you roughly about $17,000 per year of depreciation. This is really important. The IRS assumes you take depreciation, so you will have to repay it back even if you didn't take it. It's called allowed. And it's really important to understand that even if you are not taking this every year, you still have to pay it back. So $17,000 a year in depreciation. Say you own the property for 10 years, just for equation purposes. You own the property for 10 years times $17,000 a year equals $170,000 of depreciation, also recapture. $170,000. Our basis is $475,000. So you take the $475,000 basis and you minus the $170,000 of depreciation, and that's going to give you about $305,000, which is your new basis. Okay? Your new basis is now $300,000. You decide you're ready to sell, market's doing good, and you sell for, say, $700,000. You minus, let's just use $300,000. You minus your $300,000, which is your basis, and your gain is $400,000 gain. So what happens to this money? What do I do with it? What do I owe? Well, there's two equations for this one. Let's start with the first. $400,000 of gain minus the $170,000 equals about $230,000. What do those two numbers represent? Well, we know the 170 is the recapture. The 230 is our capital gains. But here's where people get lost and confused. They are taxed differently. The recapture is taxed at a 25% max, costing about $40,000 in taxes. You take capital gain 15, 20%, let's use 20%. That's an additional $45,000, totaling $85,000 of taxes that you owe. 170,000 recapture at 25%, $230,000 of capital gains. And of course, you can use the rule if you lived in it 2 out of the 5 years, but we already know you didn't because you lived in it for 10 years. So you pay capital gains on $230,000 and you pay recapture on the 170. So now you owe $85,000. This is a shock to a lot of people. How can you avoid it? You can do what's called a 1031 exchange, or you could take the property at a loss and sell it at a loss. Those are pretty much your options to eliminate this $85,000. So the IRS was nice enough to let you take that depreciation, but then they became your silent partner and they get $85,000. If you need more clarity or have more questions, please leave a comment below. I'd love to post more videos on the 1035 exchange or the 1031 exchange, and any other questions. If you need more explanation on depreciation and how that works, I use the straight line method with the 27.5 years. So there you have it, recapture.